You're watching Stockwatch this week with me, Ntauleng Lechela. And joining me to unpack your stock-related questions today via Zoom is Victor Seanie from Benguela Global Fund Managers and Jordan Toy from Legacy Family Wealth. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Gents, thank you so much for your time today. Victor, I'm still trying to make sense of market reaction when it comes to Nvidia's results. Beating estimates on the top line, on the bottom line, also that Q1 outlook and the outlook for the rest of the year quite positive, but failing to impress investors. How are you making sense of that? I think we have lost your sound.
Apologies. Yeah,
Yes.
I was saying that a lot of growth has been naturally baked into this AI super cycle that Nvidia is playing a crucial part in, and I think there's probably the whisper number that was not met. So the official numbers, there was a beat on revenue, earnings, as well as the outlook, the guidance that was given.
Yeah.
But the share price reaction suggests that the market or the buy side, whose numbers are unofficial, that their expectations probably weren't met. So I think that's what I make of the market reaction.
Jordan, your take on that. I mean, Victor highlighting there how important Nvidia is when it comes to the AI super cycle. It's one of three companies that's really integral to the super cycle, including TSMC as well as ASML. And when we saw those numbers come out, market reaction was positive. But we can't say the same for Nvidia.
Yes, I think Victor hit the nail on the head there, right? Expectations have moved continually upwards for Nvidia, and it becomes higher and higher threshold to meet, right? I think that the overall update we got out of them was pretty solid. However, the market's still disappointed, right? So I think what we're also seeing is in the last couple of weeks and month or two, a lot more concerns around AI. Like we have these two different narratives, one narrative being that AI is going to lead to massive productivity gains, and that's going to be beneficial to these companies' earnings. And then on the flip side, you have this other narrative that it potentially poses a risk to a lot of these software companies. And I don't think those two, they're a little bit contradictory to me. I think both can be true in part, but I think we're seeing that sort of overall level of fear play through into just the broader AI theme. Obviously, Nvidia is not a software company, but I think, that space is so highly valued, it's primed for, any kind of earnings miss or disappointing guidance can lead to a swift correction like we've seen in the last day or two.
Just picking up on some of your thoughts there on the software companies, was that sell-off not overdone, Jordan? I'm just thinking of Salesforce's numbers that were also out this week that were also quite positive. We did see Salesforce also mentioning that it is integrating AI in some AI tools that is in some of its business units.
So I think in certain places it may be overdone, right? Salesforce, however, I don't know if that's an example of it being overdone. I think that there's relevant concerns there with Salesforce in terms of, and just the CRM software market more broadly. Are there risks around, AI and the moat to overcome for AI to replace a lot of those functions? I think Salesforce, those concerns are most prevalent. Yeah. In other software companies, I do think that those risks are somewhat overdone. There was a recent research report that came out from Citron in the last couple of days, Citron Research. I hope I'm pronouncing it correctly, but that kind of went all around the world and painted a pretty dystopian view of what sort of 2028 may look like. I think that just something as small as that has had quite an impact on the market in the last couple of days. But yes, in general, I think the same brush is like sort of tarring all of these software companies. Some may not survive what AI may bring about in the next couple of years, but I think it's incorrect to assume that all software companies will just cease to exist and AI is just going to replace all those systems.
All right, so let's move over to the entertainment/streaming services sector. Victor, my dreams of cutting down on subscription costs has been shut down with Netflix walking away from that Paramount deal. What have you made of that move. The last time I checked, that share price was in the green following its decision to walk away.
Yeah, I think it demonstrates that Netflix management is just exercising capital allocation discipline. In their minds, they had a price that they would pay for, a maximum price that they would pay for Warner Brothers that would make an adequate return on their capital. And Paramount was pretty much determined to get this this asset under its belt. We know that Larry Ellison, who's the main funder of the Paramount bid, is not afraid of debt. The numbers that I saw that Paramount, the amount of debt that Paramount will have after making the acquisition will be about, I think, 7 times EV to EBITDA. I mean, the net debt to EBITDA. And so it's hopefully they'll be able to grow their subscriber base. Now, we've seen Paramount grow their subscriber base pretty handsomely. They're sitting at about 79 million subscribers at the moment. And so there does seem to be some pathway to recover their investment. But we know about the winner's curse in M&A. The high amount of debt that the winners take on often leads to poor financial performance. So this could be positive for Netflix, who already has a very strong capability of developing their own content in-house. Yes, they lose out on the legacy content of Warner Brothers, but they can invest in the brownfield, internally generated R&D, internally generated innovation of content. That usually has a high return on capital. And we know that Netflix has proven itself. They've won many television awards. They're able to generate content. And there's a lot else to go after, you know. If you think about this, the streamers are now starting to emulate the business models of the historical cable companies. And what does that mean? That means they're going to have to get into a little bit of live television, a lot more advertising, as well as bid for sports rights. When it comes time to bid for sports rights, and when that will be a key content element, Paramount is not going to have the budget to compete with Netflix at that point in time, because Netflix is going to have a far stronger budget. So Netflix may have just lost this battle, but you know it's well positioned to win the streaming wars in a long time. So it's not a major negative for Netflix in my view.
Will Netflix still get the breakup fee, or does that fall away, Victor, because it decided to walk away?
As far as I understand it, this breakup fee is going both ways. So there's a breakup fee if Netflix were to break up the deal, and there's one going the other way, as far as I understand.
All right, I won't.
Joy can correct me on that.
Okay.
So you are on the right track there. I think Netflix is going to get that $2.8 billion termination fee from Warner, which is going to be paid by Paramount. That was one of the sweeteners that Paramount added to their deal just to get it across the line.
All right, let's move over to some local news, kicking things off with numbers from Northern Platinum. Earnings soaring, Jordan, due to higher PGM prices. Just your read on that company's results and how it fared over the past 6 months.
Yes, so I think at a broad level, I mean, it's sort of the case of a rising tide lifting all ships, in the sense that, I mean, we had numbers out of Altera a little earlier on this week, and, you know, across the board, it seems that as you would expect, higher PGM or platinum group metal prices are helping all of those companies deliver better results. And I mean, just looking at even the intraday moves today, I see platinum prices are up, and sort of the top 10 today is filled with a lot of the miners. So, you know, long may this commodity cycle last. As a longer-term structural theme, I think that applies to whether it's Valterra or any of these platinum miners or Northam, as you mentioned, is the trend towards EVs is not materializing as I think initially anticipated. Right? We expected, you know, the EU specifically had very big targets, to electrify their market, and we know that, you know, combustion engines, there's a need in the catalytic converter components of those vehicles for platinum group metals. And that's, you know, been quite a structural headwind for these miners. But increasingly, it seems that EV uptake is far from what was sort of forecast 2, 3, and even 5 years ago. So I think that is less of a headwind for these miners going forward, even if PGM prices don't cooperate. Having said that, you know, that the mere fact that there's bigger demand for PGMs in catalytic converters and combustion engines should provide some floor under that platinum price.
Mm-hmm. Let's talk about that platinum price in greater detail. Victor, the company CEO, Paul Dunn, saying that we are seeing a bit of a structural shift here, and he expects platinum prices to remain higher in the medium to long term. Do you share the same sentiments when it comes to PGMs?
I think by and large, however, I think the platinum price at the moment, if I look at it on a 3E basis, so Valterra reported earlier this month, and the basket price that they mentioned, at which new production would be incentivized to be developed in the market, was about $2,300 per ounce on a 3E basis. And the platinum price that Valterra is priced at the moment is about 3,200. Mm-hmm. So the market is expecting these very elevated prices to remain in the market. I do think that prices will remain elevated relative to the very depressed levels that we saw in 2024. Mm-hmm. Because of the situation. So in the main PGM metals, you have deficits, platinum, palladium, rhodium, you have deficits going up until at least 2027. And even when those deficits reduced in the likes of palladium and rhodium, you don't see the market going to surplus. So simply, there's just not enough supply. Supply has been on a long-term decline. Valterra's production has been declining for the better part of the past 2 decades. Similar with Impala. The only producer really that's increasing production is Northam in the market, but they are not the biggest. That's Impala and Valterra. And so supply is very constrained, and miners are still not confident enough to invest in new supply. Yes. If you recall, 2023, we had that platinum price rally as well. It lasted for a year, 2 years or so, but it didn't incentivize new supply. The prices were high enough, but the durability thereof, and I think the EV scare, prevented companies from investing. And if you think about now, EVs will definitely increase their share over the next 5, 10, 20 years, and that's the amount of time it takes for a new mine to come online. Mm. So supply will remain hesitant. Demand is still there, given the pullback in legislation with regards to EV. So I think there is firm support for prices, but probably not at these levels, probably 10-20% lower than where we are at the moment.
All right, let's hit pause on the conversation. Before we head into a break, just a reminder to tune in on Tuesday, the 3rd of March at 10 a.m. as we'll be bringing you the live presentation of Discovery's interim results, and again at 2 p.m. for the JSE's annual results presentation. Right, back into the questions. There is a question on Copper 360, but I know both of you don't look at that company. So let's perhaps speak on the sector at large. Jordan, I'll start with you. Just your thoughts around, I guess, some of the big players in that space. We have the Anglo Tech merger at play, Glencore, BHP. Your preferred pick on that front?
So difficult to sort of pinpoint who's going to be the longer term leader here. And the reason I say that is they all sort of pivoting increasingly towards copper, right? Yeah. They all want a slice of that pie. I mean, we talked about EVs briefly earlier. And I mean, it's increasingly a commodity that is being prioritized by all of these miners. I mean, a lot of this copper supply is coming out of these massive mines in South America, and a big fight for some of these operations amongst these big miners. We'll have to see what happens in the M&A space, but I think copper, we talk, similar to platinum group metals that we touched on recently, is a metal that we're going to need increasingly more of going forward. Some of these mines have had issues in South America and sort of reduced production. Do they get those operations running a bit more smoothly, more copper coming into the market? That can affect all of these miners and the broader copper price. But again, I think that there is a baseline level of demand for copper that we just don't see going away, certainly in the medium term. Obviously, in the short term, like with any of these commodities, you can have significant fluctuations. 1 or 2 big mines go offline and suddenly the price can go up pretty significantly. But longer term copper is a mineral that we certainly like. And you need to do a quite a careful look in terms of which of these miners is the ones that you'd want to have in your portfolio.
Yeah, and talking about doing a careful look into those big miners, which one do you prefer? Copper, of course, really essential to the AI boom, but some of those big copper players also have exposure to iron ore, and we've seen what's been happening with iron ore with a downbeat demand over in China as well.
Yeah, so I mean, Glencore is one that I've always liked in the mining space. It's more of a, an all-around play. They obviously historically have been a very strong trader of metals and minerals. So Glencore is an operation that I followed reasonably closely and one that I think is well positioned in that space. As I said, it all depends on what assets you own, where in the world, and how those end up performing for you. But yeah, Glencore is my preferred pick in that space.
All right, let's get your thoughts around that, Victor. If I remember correctly, both Glencore and BHP out with results recently, and we are seeing, iron ore not doing as great as it usually is in terms of, demand, price as well.
Yeah, I think probably my preferred copper miner would be BHP Billiton. I think they generate, according to the last report, now about 56% of their earnings come from copper. And then iron ore, if we are going into a period of protracted moderating iron ore prices, then I would also want to be with the lowest cost producer, of which BHP is probably number one and number two when it comes to lowest cost iron ore producers. So it's well positioned in iron ore despite the slower growth in that market in Australia, and then it's a significant copper producer. And I think, and we know that it selects its mines really well, long life mines, low cost mines, arguably the best management team in the mining industry. So I favor BHP there. Yeah. A lot of copper exposed miners, though, their share prices have run pretty hard over the past 12 months. So I would pick carefully in that space.
Just on iron ore, Victor, with the fundamentals at play, is there still value in an iron ore counter like Kumba?
Yeah, I think there still is, provided that you get into the counter at a meaningful discount to take care of all of the vicissitudes of what's to come in the iron ore market. Pricing is not likely to rise strongly given that demand out of China is not that strong anymore. But these mines are exceptionally high margin operations. So still really great businesses, generate high amounts of free cash flow. So these are still good businesses that I would hold for the long term.
All right, a question on Sasol, Jordan. Share price up 8.6%. What's behind that? The last time I checked the oil price, it was up about maybe 0.25%, sitting around $72 a barrel. Is this on the back of what we're seeing come out of those US-Iran talks?
I think that's the primary contributor. I mean, it seems like we have the same conversations on Sasol and relations to what's going on in Iran pretty frequently, but that's still ongoing, and I think that's a big factor in both the oil price as well as Sasol's price. There are some other factors. Sasol's had some successes in the last couple of months with their destoning plant coming online, but I think primarily what we're seeing there is the lack of progress. Let me say that in those US-Iran talks. And we know President Trump's been pretty clear, that they may take military action in the next 10 days. And that was quite a while ago that he said that. There's significant US assets in the area. So, I think what the market is worried about today is potentially it doesn't seem like they're making a lot of progress. Does that mean that the US takes some military action, even if it's, I want to say, relatively measured action to try and force Iran to give up some compromises in those negotiations? We'll have to wait and see, but I expect continued volatility in both oil and specifically Sasol until we see where that whole picture moves towards.
All right, Victor, I'm going to give you another question just on the back of this week's budget that's been viewed as market positive. A question here on why we haven't seen SA Inc. stocks rallying.
I think SA Inc. stocks are still subdued in the market because of the economy. The outlook for the economy is not rosy, and the outlook for the South African consumer is also not that rosy, because it's expected that the consumer is going to continue to be pressured by costs, limits, and growth in disposable income. Unemployment is still elevated. As we've seen, that's what the retailers have been telling us. Spur this week said for the next 6 months, that's what they expect. And then you have the clothing retailers as well. Consumers were cash flush in 2024, and that created a high base coming into 2025. Hence, you saw the very low revenue growth coming out of our retailers. And also, low inflation for the food retailers is also putting pressure on sales. And that's led to the low growth environment has led to intensification of competition. You see a lot of promotional activity. So you see the weaker players such as Spar underperform significantly. Walmart, it looks like they're going to convert 20 or so of their game stores into Walmart stores, and that that could pose a bit of a threat to ShopRite as well. So it points to more competition in that market, which is negative for margins.
Touching on that competitive environment, particularly when it comes to the grocers, Jordan, I'm wondering if the likes of a Pick n Pay, the likes of a Spar, have any chance of playing catch up. We also have Walmart in the picture now.
Yes, it's a tough environment, right? We know that, most of these retailers, or grocery retailers rather, the margins are quite tight in that sector. And I think a lot of what we're seeing, and Spar's been one that I've been looking, I think the whole market has been looking at pretty closely over the last week or so. I think it broadly speaks to sort of a small step change in the industry. You look at, when I say small, it's not so small anymore, but the movement to online deliveries, online orders has set back a lot of these retailers who are 1 or 2 steps behind, right? It's increasingly trying to play catch up. Spar has its own issues offshore, had its own issues offshore that it had to deal with. But Pick n Pay as well. We look at that. Boxer has been fantastic, but Pick n Pay has been looking like a more of a value play for almost a year now. We had Sean Summers coming back to try and fix operations there and right the ship. I think what that shows you is how tough it is to catch back up once you've fallen a step behind some of the retailers like a ShopRite. Obviously, Woolworths plays in a slightly different LSM market, but yeah, I think it's a clear case of falling a little bit behind in that space. As the amount of effort required and focus from management to catch up in terms of lost ground is just massive, and Spar being punished pretty heavily for that over the last week or two.
And it's interesting to see what's at play when we talk SA Inc. stocks, where the retailers are sort of falling behind. But when you look at the financial services counters, they're doing pretty well. The banks are doing well, even though that hasn't been really reflected in the share price over the past, few months or so. But those counters are faring well, looking at some of the trading updates that have come out. One that has stuck out for me in particular is Discovery. Maybe let's talk about what we've been seeing there, and Discovery Bank in particular, and how it could sort of come through as a challenger bank long term when looking at those 4 big players. Victor.
Yeah, I think a Discovery is an excellent organization to the extent that it's not only a lower cost operator, it's excellent at marketing. It's captured the public imagination for almost 3 decades now. Anything associated with Discovery, consumers would love to have, to play a part in. And then when it comes to innovation, it's been incredible. And they found ways to attract customers, lock them in, have them loyal. Not only that, but also change their lifestyles and the way they do things. So, and it has an existing customer base that it's able to tap into to sell its Discovery banking product to. And so it's very well positioned. I believe Discovery just reported that they'll be breaking even or making their first profit this financial year. So I think that bank is going to continue doing well. It's probably going to be the number 2 new bank among all of them. And I think given the demographic that it plays to in terms of income, it's likely going to do much better than Time Bank. And it probably will get into home loans and accelerate that part of its business probably faster than the Capitec has. So I think the prospects look good for Discovery Bank.
All right, let's get into your stock picks. We've got 30 seconds for each of you. Victor, I'll start with you. Where are you seeing value at the moment?
Yeah, I decided to go with the sector today, the software sector, the US names in particular, from the likes of Workday to Intuit, so Workday HR software, Intuit financial software, to Guidewire, which is a vertical software business which provides software to the insurance industry, and a number of names, probably 8 or 9 names, both in the US and in Europe, Dassault Systems in Europe. I think the AI scare has been overblown. It has, in my view, it assumes that these companies won't do anything, but they would just be run over by AI challenges, AI native challenges. But these companies are well positioned to adapt to AI and to incorporate AI. Most of them have already started doing that. ServiceNow is a prominent name also. They have the data. And so your AI model is only as good as the data that you have. They've got decades of proprietary data that they're able to use to create very effective AI models that they can sell to their customers. They've already begun doing that. They've got the distribution channels.
Yes.
They've got the customer base already, and they're able to implement and sell AI far quicker and monetize AI far quicker than challenges. So there's a lot to recommend these software players, and they're still a sticky business. They have high margins. North of 80% GP margins that they can use to invest in AI.
Victor, I have to stop you there. Your 30 seconds is up. Jordan, where do you see value at the moment?
Well, look, we've already touched on Netflix quite a bit. I just wanted to briefly add to 1 or 2 points that we didn't cover. I think the most important thing in this Netflix deal is that, Netflix didn't need this, and their CEO said, this is a nice to have, not a must have. And I think, as Victor already mentioned, given its extraordinarily strong business, I think that actually walking away from this deal is that the right call by management, not overpaying for an asset. And that's exactly the kind of thing that's coming up in conversations with clients, right? Are they overextending themselves? And I think that this exit comes as somewhat of a relief. They're obviously getting that break, that termination fee. And yeah, I think it shows that managements are thinking more like a shareholder. And that's the kind of capital discipline that our clients expect from us in the stuff that we own in their portfolios.
Gents, thank you so much for your time and joining me today. That was Victor Seanie from Benguela Global Fund Managers and Jordan Toy from Legacy Family Wealth. And that's it from Stockwatch this week. Be sure to stay tuned to Business Day TV as there's lots more coming up.